The first part of this framework, we're looking at it in terms of the proximity of price. But there's another dimension to this, and that's the dimension of time, because this profit curve, I'll just take a little blue mark, this profit curve here is at one time, say T1, and now it's at another time up here, T2, right? That's changing all throughout the day. At T1 versus T2, those are two very different times. So what we do is that curve is changing throughout the day, and that's really representative of the premium that's decaying on that option. So let's do one more chart to give you an illustration of what premium looks like as it's decaying. You've probably all seen this chart, I'm sure. Over the course of a day, let's say that this is 0 DTE right here. And then this is the beginning of the day, 9:30 a.m. And premium starts out way up here. Starts way up here. And then as the day progresses, it does this until it decays down to nothing, all right? We could also flip that the other way and say, well, it does this. It decays up. In terms of our butterfly, if we were looking at our butterfly, it's actually increasing in value. But what's happening is it's premium that's decaying on both sides of that butterfly. And when you subtract it out because it's a debit trade, it's actually looking like it's increasing to us, all right? So all we can say is that as this is decaying, we're making money if we're anywhere on that profit curve. And so what we do is we break that day down into time periods, all right? So we'll break it down. We'll use the green. So there's a time period here. There's a time period here. Notice I make this time period smaller. And there's a reason why I do that. And that is because of the shape of the curve in each one of these time periods. This time period up here, we call the morning session, goes from the open to noon. This one goes to 2:30, and this is the close. We call this the afternoon session, really amazing name. And then we call this the closing session. And the reason why we break it down that way is because the profit curve has a very distinct character in each one of these sessions. Here it's flat. Here it's like a dog leg. And here it's falling off a cliff. So that implies then that we're going to have different ways of approaching our profit taking in each one of these time zones. Time zone 1, time zone 2, time zone 3. What we've done is we've created a framework on not only in terms of time, the two-dimensional framework. One dimension is time, where we look at how the profit curve changes and how we need to also change our strategy on how we're going to handle that. But also back here in terms of price and its proximity to that curve. Here's that curve, right? We could be sitting in zone 1 or zone 2 or zone 3 in one of these time frames as well. We could be, for instance, in zone 1 in time 1. If we were in zone 1 in time 1, that's usually where you're going to be because it's the beginning part of the day and it hasn't moved towards your fly yet. But if we're in time 1 in zone 3, well, we would be here, but the curve would be really flat. If we were in the afternoon session, time zone 2, but zone 3, then the premium curve is going to be a little further up. It's going to be up here somewhere, right? And it's going to look a little different. One thing that you may notice also, the other thing that's changing is the steepness of this profit curve. You can call that your gamma risk because what that is doing is showing you the sensitivity to price moving back and forth like this to the value of your trade. These are things that you need to keep in mind when you're trading this.